Initially, the startup founders run their startup on bootstrap. That means they use their own personal finances or borrow money from friends and relatives or use the operating revenue to establish their product and services in the market and validate their idea. To scale and grow the company, funding is required. Funding is basically raising the money to scale the business by spending that money on marketing, growth, and operating expenses in order to increase the revenue and also the profit. Now, investor invest money in the startup and get some percentage of ownership in the company in form of equity. The ultimate aim of the investor is to get the return on investment over the period of time. Now, there are various stages of funding which are also called investment rounds. It starts with the early stage seed round, in which fund is raised to basically establish the proof of concept or product market fit and establish your product and services. It is followed by funding rounds named as Series A, B, C, D as the company scales. As the business is scaling, the company needs more money to scale further. Now, to scale further, the amount raised is invested in building strong teams, operations, marketing, and launching new products and services to attract more customers and thus increase the revenue. Now, with each round, the valuation of the company as well as the amount that is raised through funding increases. Well, startups having the business model with lot of growth potential can get funding from the venture capital firms and angel investors. An angel investor usually provides some money or capital in exchange of equity or in form of convertible debt, which is a loan given to the startup that can be converted into equity at later point of time based on the terms and condition of the note. And the term venture capitalist refers to the investor who work for a venture capital firm. A venture capital firm maintains a fund known as venture capital. It is a kind of a private equity fund that invests in a high growth potential startups for return on investment. Apart getting funding from angel investors and venture capitalists, there are other funding options as well, such as taking a business loan or having a grants from government organization or other institution for startups having idea for the societal development, or raising money from incubators and accelerators or crowdfunding. All these are various options by which a startup can raise funds. Well, the startup sells stocks to investor in order to raise funding. Now, the percentage of equity that investors get is based on the valuation of the company. Now, for example, if a startup raises 50 lakhs of capital in exchange of 10% of equity, that means the company has the valuation of 5 crore. That is the worth of the startup for 100% of the stocks. Two most commonly used terms in a startup valuation are pre-money valuation and post-money valuation. Pre-money valuation refers to the estimation of the company's valuation of equity prior to the funding round, while post-money valuation refers to the equity or the worth of the company after the funding round has been completed. So post-money valuation is equal to the pre-money valuation plus the investment amount that has been raised. Now, for example, if a venture capital firm has invested $5 million for the 10% stake in the startup, then post-money valuation can be calculated by dividing the finance raised by percentage of equity ownership. In this case, it is 5 divided by 10%, which is equal to the $50 million of post-money valuation. So initially, when the company is founded, the founders of the company own all 100% of the company's issued share. So for example, initially the company issued 1 lakh share, so all the share belongs to the founders. And as the startup is raising the funds, this equity is getting diluted. For example, if a startup raises 20 crore of funding in exchange of 10% of the company equity, then post-money valuation can be calculated dividing 20 by 10%, which is 200 crores of post-money valuation. And pre-money valuation can be calculated by subtracting the amount raised from the post-money valuation, which is 200 minus 20 crore equal to 180 crore of pre-money valuation. Here, share price can be calculated dividing pre-money valuation by the existing number of shares. Here it is 180 crore by 1 lakh of the outstanding shares. So each share price comes about around 18,000 rupees. Equity dilution happens as the startup issues 11,111 new shares, which is in proportion to the funding raised, that is 20 crore. Now, equity dilution is unavoidable during fundraising, but as the number of shares owned in the company establishes the ownership, so it is very crucial for the founder to ensure that their equity is well protected. So it's crucial to know how much cash a startup needs at present time and refrain from raising more funds than required to safeguard the company's ownership or equity. Last but not the least, one of the important component of business plan is exit strategy. It is a part of the financial section of the business plan. Basically, an exit strategy gives the business owner a way to reduce or sell their investment in a company, especially if the company is successful, then make a sizable profit and get a return on their investment. Some of the well-known exit strategies include merger and acquisition, which means getting acquired or merged with big company in which investor gets a chance to sell their shares. Well, another well-known exit strategy is selling your stake or share to the partner or to the other investor. And the most popular one is going public, in which company goes public by listing on the stock exchange by launching an IPO, which is initial public offering. It is a process of selling the new share of the private company to the general public. An IPO can be part of a private investor's exit strategy, in which there is a lock-in period, and after the lock-in period has passed, private investor can sell their private equity to the general public. So these were some of the well-known exit strategies. Liquidation and bankruptcy are two of the exit strategies for the worst case scenario. Liquidation is the process of closing the business and selling the assets for paying to the creditors and shareholders in order of their priority. Liquidation can be voluntary, but it is triggered when the company is unable to pay its debts. And last, bankruptcy, which is a legal process in which people or entities who cannot pay their debt to the creditors can seek a legal proceeding to start fresh by forgiving the debts that they can't pay. The downside of the bankruptcy is that it affects the credit score of the person or entity and the reputation as well. Meanwhile, the creditors will get a chance to get some of their repayment by the process of liquidation.